If you're in the crypto space, you know one thing. There's been a lot of noise, but underneath all of that noise, there's one thing that I think remains pretty obvious. 2026 is shaping up to be one of the most explosive macro years that we've seen in a very long time. Now, that's a fundamental statement. That's not so much an opinion. When you look at everything that is lining up right now from a macro perspective, you see exactly what I'm talking about. You have the politics of it all, fiscal policy, liquidity, AI, and even the future leadership of the Federal Reserve all converging into one moment. And when all of those things line up and converge together, I'm not just sitting here saying, hey, we're going to get a rally, but you get a regime shift. So in this video, I'm going to break down how massive political gasoline is about to be poured directly onto the financial system. At the exact same time, the Fed's liquidity engine is flipping direction, while AI spending triggers a real economy demand shock, and how all of this sets the stage for one of the most asymmetric setups crypto has ever seen. So let's start with a piece of this that we really need to talk about, and I've not talked really much about it at all, because it's one of the sparks that lights everything else. It's politics. So 2026 isn't just another year in the cycle. It's the year when political incentives, fiscal expansion, and monetary appointments all collide together. So let's start here. The US deficit is already near $1.8 trillion. Not in a recession, not during a crisis. This is just normal operating mode. The Committee for a Responsible Federal Budget put it bluntly. The government is borrowing $5 billion per day and posting nearly $2 trillion deficits outside of an emergency or recession. And when it comes to fiscal policy, campaign promises are turning into fiscal accelerants. Over the past few months, we've seen headlines everywhere about income tax cuts, lower capital gains, tariff changes reshaping revenue streams, and the big one, most recently, talk of $2,000 tariff dividend checks going directly to households. I mean, just look at the headline. Trump promises to send $2,000 tariff dividend checks probably in the middle of next year. Trump is committed to $2,000 tariff dividend payments, White House says. Now, whether someone really likes or dislikes the policies, it does not matter at all. Markets don't care about your politics. They care about flows, spending, and incentives. And the incentive here is crystal clear. Make voters feel better in 2026. And here's the part that we often forget, but it's already locked in. Powell's term ends in May 2026, and Trump gets to appoint the next Fed chair. I can't say this enough. That is a massive macro variable. Trump told reporters in the Oval Office, I think I already know my choice. I'd love to get the guy currently in there out right now, but people are holding me back. A new Fed chair aligned with a pro-stimulus, pro-market administration could reshape the pace of rate cuts, the approach to balance sheet expansion, the Fed's appetite for liquidity injections, and the entire risk asset environment. And this aligns with a broader political agenda of keeping markets increasing, jobs stable, consumers spending, and GDP looking strong heading into 2026, 2027. So let's be very real about this. This is political gasoline. It's gasoline pouring directly onto a macro engine that is already starting to ignite. And now that foundation is set. So here's where it gets crazy. This political cycle is colliding with two other forces at the exact same moment. The liquidity engine shifting direction, an AI capex supercycle that's absolutely monstrous. So let's break those two things down. Obviously, as you know, I've talked a lot about the liquidity engine is quietly flipping. We've lived through one of the nastiest liquidity drains in modern financial history. Reverse repo went from $2.5 trillion to basically zero. The Fed's balance sheet was pushed into aggressive quantitative tightening. Banks ran tight on reserves. Liquidity vanished from everywhere except AI megacaps. But now, all the signals are flipping. QT is ending. The Federal Reserve announced it will halt Treasury balance sheet runoff effective December 1st, 2025, ending the quantitative tightening program 3 years after it began. That is a headline I think that we will remember. The drain stops. And federal officials are officially saying that reserves are too tight. Let's look at the recent FOMC minutes. The manager highlighted that recent changes in money market conditions indicated that the level of reserves could be approaching ample. So my point here in reiterating this, because I know I've mentioned it before, this isn't speculation. This is the Fed telling you the liquidity regime is shifting. So they're all about it, everybody, which is a sign of stress beneath the surface. They know it. The kind of stress that forces the Fed to step in with stabilization. Many people, including myself, think the Fed and Powell just pushed way too hard, waited way too long, and now here we are. So combine this with the 2026 Fed chair transition, you now have fiscal expansion, political incentives, liquidity stabilization, and potential balance sheet expansion on deck. Look at this headline. The market's biggest headwind is about to disappear. Roughly $95 billion per month was being pulled out of the system. That's about $1.4 trillion since quantitative tightening began. Now that ends. This alone is a powder keg, but now you sprinkle AI on top of it, this becomes something else entirely. Because here's the thing, AI is not just a tech fad. It's a real economy capex explosion. According to Gartner, global AI spending will reach close to $1.5 trillion this year and will top $2 trillion in 2026. Data centers, chips, infrastructure, energy, semiconductors, the demand is enormous and persistent. Look at this. JP Morgan global data center and AI infra spend to hit $5 trillion. NVIDIA becomes first company to reach $5 trillion valuation fueled by AI boom. Do you realize that's larger than most countries' entire stock markets? This is a global capital rotation. Corporations are spending like crazy to build the next economic layer of the world. And here's the macro part people are missing. This AI movement isn't optional. It's mandatory for competitiveness. By 2030, data centers are projected to require $6.7 trillion worldwide to keep pace with the demand for compute power, which means this spending pushes GDP up, pushes earnings up, pushes valuations up, pushes liquidity needs up, and forces central banks to accommodate. If you're a policymaker watching trillions flood into AI infrastructure, you don't run restrictive monetary policy into that. You support it. AI is effectively demand pulling liquidity back into the system. And now we bring all three forces together. When you combine political gasoline, deficits, tax cuts, checks, voter incentives, and the 2026 Fed chair transition with liquidity engine shifting, like quantitative tightening, the balance sheet stabilization, repo stress, signals of future expansion, everything we've been talking about, and the AI supercycle, you get what I would call a macro environment that is fundamentally incompatible with a sustained multi-year risk-off cycle. Volatility? Yes, probably. Pullbacks? Probably. Scary periods? Probably. When does that ever end? But structurally, this is the exact setup that usually produces the biggest upside moments for risk assets. And crypto is the furthest out on that curve. Check this out. Bitcoin's correlation with global liquidity is not only strong, but also has the highest degree of directional consistency with global liquidity conditions relative to other asset classes. I want to show you a couple more headlines. The real reason Bitcoin has struggled and why it can surge to $180,000 in 2026, according to Citigroup. Citigroup strategists wrote, Bitcoin is a more sensitive instrument for pure liquidity. And with the Fed stopping balance sheet runoff in December, that liquidity picture is about to change. One analyst put it simply, 2025 to 2026 still look bullish. Global liquidity is rising once more. Japan, China, and the US are all adding money in their own ways. Bitcoin will soak up a big part of those inflows. This is why 2026 is such a big deal. It's not just another year, it's the convergence point. The pipes, the politics, and the technology all point in the same direction. So as we head into this new era, don't get stuck staring at weekly candles or a weekly moving average and just calling a bear market and convincing yourself we're in some long-term doom spiral. Zoom out. Look at what's forming. 2026 isn't shaping up to be a normal year at all. It's shaping up to be a macro tsunami. And for people who understand these cycles early, those are the moments where massive opportunities are made. And as I say in every video, everybody, this is the data that I'm seeing. I want to present it to you. It's just my opinion. I don't know what will happen, but I know what I think will happen. So whether you're a bull or a bear, it's all good. I appreciate you watching the video. If you found any value from this video, please consider subscribing, hitting that like button. I appreciate all of you watching. If you're not in our intelligence system with our risk models, if you're a macro investor, get back there, try us out. We have a free trial going on right now and start planning through these cycles based on risk and data, not emotion. I appreciate all of you watching. I will see you in the next video. God bless.